up, everybody? It's me, Chris Bain at Keller Williams Realty, and I'm here with my associate and broker of record, Robert Shantz with Keller Williams San Diego Metro. And
hey, Chris, how are you today?
Fantastic. Thanks for asking.
Hey, great to be here with you.
Well, thanks for coming on board. We're going to be doing a lot more of these videos just to talk a little bit about what's going on in the housing market, in particular in San Diego, but we're also going to cover a few national things as well. And one of the things we wanted to do was give you a market update with what's going on, because there's not a lot of this being picked up in the news media, and we kind of think it's important that we're starting to see a shift happen in the market.
We are definitely experiencing the beginnings of a shift. We were talking earlier today, and I was saying this feels a lot like 2006.
Right.
And what I mean by that is when we saw such a huge run-up in 2006 with the housing market, now that was precipitated by a lot of other factors like liar loans and everybody getting mortgages they couldn't afford. However, we were seeing activity in the market at a level that shows that when you're seeing that, you're probably going to experience a shift really soon.
Right. So some of the things that we actually are seeing, let's go over those. Let's start with the luxury housing market.
Okay, so luxury in San Diego County, it's considered $950,000 and above.
Mm-hmm.
We are seeing a slowdown in that market. Inventory getting up there, we're seeing probably a little bit more than like 18 months of inventory in the high end.
Right.
950 and above, maybe about more than 12 months.
Mm-hmm.
And the reason that is significant is because luxury homes are typically owned by business owners. And when business owners might see a shift in their business, they tend to pull back on capital expenditures, like luxury homes or new homes. So that their business is slowing down, so they're not going to go buy a brand new house.
Right. And then days on market, we're seeing days on market increase. Now, the days on market in the lower price point, and we're talking pretty much anything under 300,000, they're still moving pretty quickly. And that's what we're seeing.
Well, with rates like this, you're going to see that because everybody's wanting to get into the market. Like we say, it's crazy.
Right.
And if you are not in the market, you're like, I need to buy before prices get higher.
Right.
So there's three markets.
Right. And you want to tell us what those?
So there's your entry-level market, which is really kind of all but dissipated in San Diego.
Mm-hmm.
There's your move-up market, which is up to $1 million, and the luxury above $1 million.
Right. And so the markets that we're seeing increase with the days on market are that what we call a move-up buyer. And so the move-up buyer is somebody who's gotten into an entry-level property, and then they want to sell it and then move up into that, just take that next bump up into that higher price point. And we're starting to see those days on market increase as well as what we had mentioned just a few minutes ago in the luxury market, which is the indication that another shift is coming. HELOCs, you want to talk about HELOCs?
So, interesting paradigm going on too. About 10 years ago, people were doing home equity line of credits on their home, and they did a 10-year teaser rate, and those rates came back to get readjusted about a year ago. And so what we're seeing with those type of properties that have a HELOC, and if someone's on a fixed income, and all of a sudden their payment goes up $400 or $500 a month, that's a big difference for a lot of people, and this is what's happening. So there's $88 billion in HELOCs that are resetting this year, and they started last year. And we are seeing that play into the market. No economist is talking about it. The government's not talking about it. However, we're seeing some NODs or notice of defaults showing up.
I was just going to say that, yeah.
Yeah, we're also seeing people that went through a loan modification 5 or 6 years ago, or 2008 and 9. Come back around again because they were in a house they couldn't afford initially, and now the mortgage is reset and they really can't afford it.
Right. And that's it. And like Robert mentioned, default notices are up, and they're actually going up pretty significantly.
Well, there's a report in the newspaper that NODs nationwide is below 5%.
Correct.
So that's leveled out, but the ones that we feel that are having the NODs come back on the market were those ones that went the first time through the system and then did a loan modification.
Right.
And we're seeing them having their options run out. Like, they don't have any more options.
They really don't. In fact, we've met several people that they're still feeling the effects of the last housing market and some of them just haven't quite come to terms with it.
So if you're listening to this and you have done a loan mod in the past and you're now in a situation where you're behind in your mortgage payments, the banks aren't waiting around this time. They're actually going to foreclosure a lot quicker. And they're going to foreclosure a lot quicker if you have equity, because they know the market's shifting. They're preparing for another shift, so they want to get in, get that property, get it off the market, and get it to the market and list it off their books as soon as possible. They don't want to be happening what happened the last time where they had a lot of inventory.
And it sits.
Yeah.
And it sits empty, and then prices go down.
So I know of 5 cases where one of my agents, or a couple of my agents, have had sellers or potential sellers say, well, no, I'm going to do a loan mod. And then the bank went ahead and foreclosed. And they lost. When you get foreclosed on, you lose that equity. It's gone.
Gone. Forever.
Goes in the bank's pocket.
The only time you get that equity back is if they do go to the courthouse steps and they do sell it. What will happen is if an investor purchases it, then the investor has to pay out the difference on what. But that's the only way you get to do it. But it makes sense for the bank to take your property back, because then they don't have to. They've already got that equity built in.
Yeah. And then the other thing we're seeing that's indicator of a possible shift is when you see vacation markets like Palm Springs or Florida or even San Diego, but mostly Palm Springs. I have a friend out there that's an agent, and he called me and he says, what's going on with the market? Because he kind of looks at me as a mentor for him. And I said, well, what do you mean? He goes, well, I haven't sold a home in 4 months. And we went from 2 months of inventory to 8 in less than a month.
That's significant.
So that's a shift. When you have a Palm Springs market increasing their inventory in less than a 1 month period.
Right.
And it takes one little article to say that buyers are pulling back, and everybody decides to pull back.
Yeah. Let's talk really quickly before we go appraisal issues, because we're starting to see that, because one of the things that we're experiencing as agents that I've noticed is that people are asking exorbitant prices for their property. They're going under contract for whatever the buyer and seller come to terms with. The biggest challenge is when it comes to the appraisal, because the appraisers they're conservative.
So here's a challenge in a market that's going up, as it's been going up. Sellers hear, oh, I can get a lot for my house. So they price it up here, but it needs to be about here, because that's where the market will really accept it. But they're still saying, no, I want here. And so buyers are crazy, and they'll do whatever they can to get into a house. And all of a sudden, they go to get the bank loan and they get the appraisal, and it's not appraising.
Yeah.
And that's always in an escalating market. You'll have appraisal issues. When the market's starting to tap out and top out, you're going to see that more and more. And so if you're a buyer and you're making an offer and they're asking you to remove appraisal contingency, don't do that.
Bad idea.
Yeah. If you're a seller, you need to price at the market, because you'll get more people to look at your property.
Right.
Not less. When you price it competitively, you'll get more people to look at it, and you'll probably end up getting a little bit more than actually real market value on it.
Yeah.
So don't be greedy.
Don't be greedy.
Yeah.
Don't be greedy. All right. Anything else?
So what's significant about this market? We don't know what it's going to look like in regards to a shift. Even people within Keller Williams systems say that. We don't know what it looks like. We do know that there's going to be a correction coming on board. And significantly, if you're looking for an agent to list your home, make sure they know that they're pricing it right.
Yeah.
Because if you don't price it right out of the gate, you will probably end up getting less than you bargained for.
Yeah.
So you got to make sure that that agent has been through a market shift. Both Chris and I, we've been through several markets. We know what they're like. And if you've got an agent that's less experienced, you might want to ask some questions. You know, what's your plan?
What's your plan?
What's your plan?
Have you been through a shift?
Yeah.
Have you been through a short sale market?
Yeah.
That was huge. I processed hundreds of short sales.
Yeah.
Hundreds.
And so that's a major thing. And here's really what's happening too is when we look at people who are saying, well, there's nothing for sale on the market. Here's really what's happening nationwide is you have the largest segment of the population, the baby boomers, which is about a lot of people, like 74 million baby boomers that are retiring and they want to downsize.
Right.
And then the other market behind them, which is even bigger with their 75 million, is the millennials.
Right.
Well, the reason why we're having an inventory shortage nationwide is we have all these baby boomers that are sitting in properties that are paid for, they're all paid off, and they have really low tax rate, especially in California because of Prop 13.
Right.
And they say, well, honey, let's retire, let's downsize, let's go do an urban type living and live in the city, and we'll get a nice condo and we can have that lifestyle that we want.
Mm-hmm.
So here's what happens. They go down to the city to get that dream 2-bedroom, 2-bath apartment in the sky. And then what they discover is if they were to sell their home and move down, that 2-bedroom, 2-bath becomes a 1-bedroom, 1-bath because of the price.
Right.
And
the taxes.
And the taxes. And in order to have their tax base convey, they have to buy something of equal or lesser value.
Right.
So
and that's impossible.
And if that's not happening, then they go back to their home and they say, well, maybe we'll just retire here and live out the rest of our lives here.
Mm-hmm.
So we have a big segment of baby boomers that are not selling their homes.
Right. They're just staying put.
They're staying put. And the European model, which is what is happening, is they've decided to stay put, and then now they're going to pass those properties on to their offspring,
Yep.
their kids. And that's really what's happening.
And then those kids aren't buying anything, because why would you buy something when you have a house that's paid for, right?
Exactly.
All you have to do is remodel it. So you're just putting the money into it to make updates.
And the only thing for San Diego County in particular that they're building, they're not building affordable housing. They're building luxury high-end. There's
And they're building rentals.
Included the rentals too. They're even luxury high-end rentals.
Right.
They're not even building affordable rental units.
Right.
So it's kind of scary from a long-term perspective of our prices in housing are still probably going to go up, and there's got to be a point where everything, like you can only put so much water in a balloon.
Yeah, it's going to explode.
Yeah, then it pops.
Yeah, it pops. So if you have any questions, feel free to reach out to either one of us. My number is 619-818-2992. Robert?
And I'm 619-985-5074.
If you need anything, we're here for you. Hope you have a great day, and we'll talk to you soon. Bye.
Bye.